This is John Polemy from the Actionable Intelligence Alert. Today is January 20th, 2018. First chart I want to go over here is a equities versus commodities chart. Basically what it's showing is the S&P 500 juxtaposed against the S&P Global Commodity Total Return. So basically what we can see here is that we have a median 4.1 here along this red dotted line. Anything above the red line would indicate where commodities were overvalued relative to equities. And when I'm saying equities, I'm talking about the stock market. Conversely, anything below where these green circles are would be areas where there were extensive or historical huge amounts of undervaluation of commodities versus stocks. So we are in a situation here, if you can see, this chart goes all the way back to 1970. So this is about 48 to 50 years here. And we could see that there were three instances where we have this huge amount of undervaluation of commodities versus stocks. The first one was back in the around 1972 timeframe. Then again, during the dot-com bubble, which was 1999, 2000. And again, currently, we are seeing commodities extremely undervalued. As a matter of fact, the most undervalued they have been relative to stocks in the last 50 years. Now, I don't have to point this out as it's obvious. You should be able to see the pattern here. But when we reach these levels of undervaluation in commodities versus the stock market, we've seen the last two times this happened. We saw a massive amount of correction to the mean here, and the mean being right here at 4.1. So what we can expect to happen over the next year, 2, 3 years, where however long it takes, we should expect the stock market to, or one of two things could happen, or three things. We should expect commodities not to do anything and the stock market to come down. We could expect the stock market to not do anything and commodities to rally. Or what's more likely is that we will see money move out of the stock market and equities into commodities. And this actually makes sense. It's pretty typical at the end of a long economic expansion like we've been in currently to see commodities and raw material prices rally. And that makes sense. As economic growth continues higher, the ability of raw material suppliers to keep up with demand is limited. It takes, as we've discussed before, or I've discussed before many times in articles, you can't just go and flip a light switch and have a new copper mine come online. You can't just have an entire oil field just come online. You can't have some Stanford computer science graduate stay up all night and write an app that's going to give you more nickel. That's just not how things work. So that's the logic behind why these cycles happen. So what's most likely going to happen here is the economy around the world, we're now in a globalized, synchronized growth around the world, and I'll show a chart that talks about that. And as the economies advance, they grow faster than the ability of the raw material suppliers to bring on new supply. So we get higher commodity prices, and at some point they bring on sufficient supply. They then oversupply the market, yada, yada, yada. So what we should expect to see is a rise in commodity prices and we already have started to see that, by the way. That should continue, and we should see the stock market money rotate out of a lot of these overvalued stock market names and into commodity names. The reason why, as I said earlier, this is the JP Morgan Global Composite PMI, and PMI stands for Purchasing Managers Index. This is an index of purchasing managers that's a survey done, and it's used as an indicator of whether or not the economy, purchasing managers, it's kind of like a a leading indicator. They're on the front lines buying things. So if they are buying more and more, the index goes up. So basically, without getting too far into it, anything over 50 indicates expansion in the economy. Anything under 50 indicates contraction. So this is the global composite. So this is the entire world. And if you can check this out on this website, Trading Economics, it's free. They have every country on there. You can go on, but they basically, here's the PMIs by country. They have, as you can see, the major economies. And if you notice, like especially around in the European area, it's really booming. It's at 58. France is at 59. These are like generational highs, by the way. Even Russia, United States, everything is hitting on 16 cylinders. So this is one of the indicators I follow to determine if things are in expansion or contraction. And as you can see, this goes back just a year. You can go back and check different time frames, but you can see the world economy is actually accelerating. And this is to be expected, right? I mean, we've had 8 years now, 10 years now of trillions and trillions and trillions of currency units being printed by every major central bank. The United States, Fed, the European Union, ECB, Japanese Central Bank, Swiss Central Bank, Bank of England, Bank of Canada, everybody has just been in printing mode, creating currency. And so finally, they've thrown enough liquidity at this thing that the economy's finally got traction. And, things are taking off. Now, this is very dangerous because with all that money laying around, especially like look at Europe. I mean, as I said earlier, the Euro area, France, Germany, some of these things are at like generational highs. And yet the ECB is continuing to create free money. I was listening to a guy the other day, a motivational speaker. It's kind of an interesting character, a guy named Dan Pena, and he was talking to some of his mentees, and he's on YouTube. And he said, if this is the era of free money, 5,000-year lows in interest rates. If you can't make money now, you can't make money. I mean, they are giving money away for basically free. And this is leading to all types of malinvestment, all types of projects that would never, ever be considered or financed. But that's a whole other story. But that's why we have this globalized, synchronized growth right now. I mean, every major central bank is throwing money at this still. And, the Fed has said that they started raising short-term rates. They said that they're going to start shrinking the balance sheet. But we have to look at central banks in totality, right? I mean, around the world. Central bank activity in aggregate, if you take all of their actions together, is still increasing the global money supply. My view is that their actions are fungible. So just because the U.S. is slightly pulled back, the ECB and the Bank of Japan still have their foot on the gas. So, money can flow all over the world, and it does. So in aggregate, if the money supply is still rising, we're going to continue to see, I believe, accelerating economies. And the danger now being, as raw materials now are catching a bid, we are going to see possibility of some inflation start working its way into the system. And what typically happens is, if you look historically, central bankers are no different than any other central planners throughout history. This view that we seem to have that these Ben Bernanke, Janet Yellen, all the Mario Draghi, they're all like these geniuses sitting there pulling the levers and pushing the buttons in the right sequence, and they're managing the economy. It's ridiculous. I mean, everybody listening to this podcast, anybody I've ever talked to, if there was a government agency that was setting the price of canned peaches in syrup and saying it costs 58 cents and you will pay that, I mean, everybody would laugh and think it was ridiculous. But when we sit here biting our fingernails every month wondering what the Federal Reserve is going to do with interest rates, I mean, it's stupid. But this is the way things are, and this is the way that things are traded. So this is what we have to follow. So this is one of my indicators that I really take a good look at. I watch this. I look at that country level. I look for slight changes. But right now, the world economy is in expansion mode, and it's being fueled by cheap money. So I want to take you over here and look at a couple of other charts. Let's look at this is West Texas Intermediate Crude, the price for U.S. crude. As you can see, since September of last year, and you can go back even further. Let's go back a little bit further here. I mean, we were down in 2016. I'm only going back to 2016. We were under $30 a barrel. Now we're up to 60, and this is 18 months. I don't know, 2 years maybe. Okay, it's 2 years. So we're a little bit overbought here. So I expect the price of oil to pull back in. But if the world economy is increasing, folks, energy demand goes up. And the ability to, like I said, bring on new supply lags how quickly the economy is expanding. So that's why the oil prices went up. We're big on tracking comparative inventories. They're coming down. There's a good opportunity here, but I think we're overbought, so we're due for a pullback. But you could see the trend, and you could see this breakout. I mean, this thing's probably going to go a lot higher. Copper the same way. I mean, copper, they call it Dr. Copper. Why do they call it Dr. Copper? Because copper is used in so many different industrial activities and so many components of manufacturing that when you see the copper price moving higher, it coincides with like I showed you earlier, the Purchasing Managers Index and some other things that we follow. You can see that this is consistent with the economy expanding. And this goes right back to this is basically the election here in the U.S. I mean, this thing has taken off since Donald Trump has been president. And I'm not going to get into a big political thing. It's really irrelevant, but I really think that 2018 is going to be a big year. I think the economy is going to surprise on the upside. I think raw material prices are going to roar. I think that inflation is going to start embedding itself into the economy again. We haven't seen that in many, many years, and people aren't used to it. And they have it set in their mind because we haven't seen inflation in the last few years, that we're not going to see inflation. And I think the animal spirits, that's one thing Donald Trump's really good at. He's really good on rah-rah and things and getting the animal spirits going. And we haven't had that. We've had this despondency. I mean, a lot of people listening to this podcast don't remember. This is setting up almost exactly like I remember when I was a kid. I'm 50 years old. I remember the Carter administration. And when Jimmy Carter was in office, it was similar to Barack Obama. I mean, this guy didn't know neither one of them. I mean, most of these politicians don't know anything about anything. But Jimmy Carter was similar to Obama, that he didn't really have pro-market economic policies, and the economy suffered greatly, and people were really aggravated and pissed off. I was a kid when this was going on. I remember the high inflation. I remember the joblessness, high interest rates, stagflation, it was called back then. And then Ronald Reagan came in and did basically what Donald Trump is doing: cut regulation, cut taxes, although his tax cut was a lot bigger. And rah-rah, it was Morning in America, they called it back then. Now it's Make America Great Again. And I am a big advocate. This is really fascinating to watch, because, it's not the economy. We have economists, they try to apply the scientific method to it, like in engineering or biology or physics. And you can't do that because you're dealing with human beings. And human beings are psychological animals, and they're herd animals. And when bad times are there and people are despondent, it spreads. It's like a wet blanket on top of everything. And then now we've seen this change, and this rah-rahing and this changing of the guard and policies. And you can see it's kind of similar to what I remember when I saw the transition from the Carter administration to the Reagan administration. Everything's rah-rah, everything's good, everything's always perfect. Look out, this train's coming down the line. Whether you agree with it or not, that's how it is. And everything's positive all the time. And we're starting to see that filter in. And if that you had this huge pile of dried brush that's been accumulated for 20 years, and we had 8 years of the Obama administration, and things really weren't that good. A lot of people in middle America, and now we have this new Make America Great Again, and now we have this tinder brush that's built up for dried stuff, and Donald Trump comes along, pours gasoline on it, and throws a match on it. So things are really, really rocking, and I'm not going to, whether you agree with his policies or not, or what, I mean, this is just how things are. I don't trade ideologically. I don't invest ideologically. I look at the way things are. And right now, the world economy, I mean, last year, folks, was the first year in like decades that there was not one down month in the U.S. stock market. Now, the U.S. stock market is tremendously overvalued. There is no doubt. But I think this thing can go higher. I mean, they're going to, the animal spirits are cooking. It's starting to, this train's picking up speed, and they're going to suck in every dumb dollar into this thing. And that's what's happening. And when this thing finally runs out of steam, I don't know when it's going to be, 2-3 years down the road. I don't know, but we'll cross that bridge when we get to it. Right now, things are rocking and rolling. Really quick, wanted to talk about Bitcoin. It looks like Bitcoin bit the dust in the last few weeks. I've written about it. I've tweeted about it. I've put it on the Facebook page. Like I said before, I have basically sold all my Bitcoin a long time ago. I have some legacy mining contracts that are producing a small amount of Bitcoin, but I'm out of it. It's just, it got too far out of control. That's my view. I think a lot of other people, it just, when you have these parabolic moonshots, they don't keep going up. They don't just correct 20% and then consolidate, then move higher. I guess it's possible. Anything is possible, but looking at the chart, it's like the biggest bubble of all time. And now you're starting to see the fraud, like this BitConnect or whatever. Some of these things are going bankrupt now. And it was just like I stated in the year-end issue or the predictions for 2018, various governments now are stepping in, tax authorities are stepping in, and this thing is going to get reined in. And the easy money, the idea that with no particular insight or not knowing anything and no work that a person can get rich, that's just stupid. And it's not how things work. And the apex of that idea for this particular mania, I feel, has reached the top. And there could be a dead cat bounce. These things don't go straight up and they don't go straight down. And there's going to be many bear traps, or bull traps, I mean, along the way, where it drops 30-40%, rallies back 20% because people think it's a value now, so they're going to put new money in, and you always buy the dip and all that. I've already seen this kind of stuff on different message boards and people I talk to. That would be an opportunity for me if I wasn't out to sell. That's just how these things resolve. And then when it drops again, I mean, they have to beat the euphoria out of people, and that's what those things do. They'll rally, they'll give a false optimism, and then they'll deteriorate further. Typically, when a bubble bursts, you will see the asset class that the bubble mania was in typically decline 85 to 90%. So I could see Bitcoin going down to $1,000 or less. I don't still understand the utility. I don't understand what it's used for. I don't think anybody is using it. It's just a speculative vehicle. It's no different than the baseball card mania or the Beanie Baby mania, as far as I can tell. Everybody talks about the blockchain, but if you own Bitcoin, you don't own the blockchain. You own Bitcoin. And I've heard it sold that, well, if you own Bitcoin, you own a part of the blockchain. That's not a good argument. That's the argument I heard back in the tech wreck back in 99, 2000, when pets.com and drcoop.com and CMGI and all these ridiculous internet companies that went straight up like the Bitcoin did. There was all kinds of rationalizations for why those prices were high and were going to go higher. It didn't pan out, and a lot of people lost a lot of money. So if you're in Bitcoin or cryptocurrencies, hey, leave me a comment and let me know where the utility is in this thing, or how you value it, or why it's undervalued now. I don't understand it, but that's fine. What I do understand is that, take a look at this. This is the gold price. It's interesting that this is right around the time, right here in this December, early December, mid-December area, when Bitcoin started, or the cryptocurrency started having their decline. And we see the gold price has really rallied nicely. What people don't understand, let's go back a year. I mean, the gold price, folks, has basically been up 2 years in a row. You look at the beginning of 2016, the end of 2016, the beginning of 2017, the end of 2017. I heard an analyst on in Canada on a video say that people really haven't been paying attention to gold because all the focus has been on these cryptocurrencies. But as you can see, and I just pointed out, gold has been oozing, was the word he used, higher. And I can see if things play out like I laid out earlier in this video, with commodities moving higher, gold will move higher also. You know, it's a little bit overbought now, but it'd be interesting to keep an eye on gold. If gold can make it above, you know, this 1375, move towards 1400, it could be something to look at. I've started buying some gold stocks. I put out a buy on Dynacorp Core Mining, which just does gold processing down in Peru. But I'm looking at other gold stocks now. I'm taking a look at them. They're very cheap relative to they haven't really moved. So I think they offer a unique opportunity, especially if the gold price, it doesn't even really have to move that much higher. I mean, an interesting thing about the gold price is since the collapse in gold prices from 1900, quite a few of the management teams and a lot of the larger mining companies have turned over. And there's really been a focus on cost control and appropriate capital allocation and looking for adequate returns. I mean, mining in itself is a terrible business to be in. It's a very difficult business, and it's a hard business to make money in. And when the gold price was rallying hard a few years ago, going to 1900 before it rolled over, we saw all kinds of gold company managements just out there just buying other gold companies, paying outrageous prices. And then when the gold price collapsed, the money that was borrowed or the mines that were bought weren't economic or didn't make sense. So I think we've turned over quite a bit of management. I think there's a different mindset now. And even with the gold price, I mean, some of the earnings that we're starting to see from some of these gold mining companies, they've really got their costs under control. And at a $1,300 gold price and your cost, all-in cost is $950, that's a nice margin of $300 to $400 an ounce. You can make quite a bit of money doing that. So starting to take a look at some of the gold mining stocks. I think that if the commodity complex in general, like we talked about earlier, keeps moving higher, then I expect gold price will participate in that also. And like I said, we can see since Bitcoin looks like it may have blown up, we've seen that rally. It was interesting. I tweeted out a article, bullion dealers, since this has happened, since Bitcoin kind of imploded a little bit, they saw some of the bullion dealers in Switzerland and other places were seeing like 400% increases in phone calls and sales. So gold has been around for 5,000 years. Bitcoin's been around for about 5 years or whatever. Gold is a store of value for a reason. I don't have time to get into it today, but it looks like people are rotating back. Some people are rotating back to it. And the interesting thing about gold is the traditional buyers of gold, which have been the Indians, Chinese, Russians, a lot of older European money, that demand has stayed there. The only people that have really backed away from buying gold have been investors in the United States. So just to summarize, we are looking at globalized synchronized growth. We are looking at commodity demand starting to increase. Prices are increasing. we're looking at commodities relative value to stocks is at a 50-year low. That looks like a pretty good setup for a trading over the next year or two. I think a tremendous amount of money can be made. Obviously, some of the commodities have gotten ahead of themselves. Nothing goes straight up. But I think on any pullbacks, it would behoove people to take a look at rotating some money into resource stocks. And I will be mentioning, I've already mentioned a few on the website. I'll put links to the articles where the articles that I'm bullish on. And that's where I see tremendous value right now in this market. So that's it for this week. Thanks for listening, and we'll talk to you next week.